Thanks so much for the introduction. David's also stolen half of the content for all of my slides. So I've done a few of these talks before. And this one I wanted to start a little bit differently by saying, I think you've made two good decisions. The first good decision, and by far the most important, is that you're here this evening listening to me. And the second, arguably more important decision, was the fact that you chose to go to LSE. You're going to get a lot of opportunities at LSE to hear from really impressive speakers from all sorts of different walks of life, all sorts of different backgrounds, and I really encourage you to attend as many of those as possible. When I look back at my own university experience, I went to university in Durham, and I wish that we had had more speakers, and that the speakers that did come, that more people had attended and listened, because I think you can learn a lot from the people that have gone before you, regardless of whether you end up going down that path or not. The title for my talk today, How Not to Find a Great Business, is probably a bit different from what you might hear most people come and talk to you about. Although the reason why it's a little bit strange will become more apparent as we go through the presentation. It's roughly 20 minutes, and then after that, very open for Q&A, or if you have any burning questions in the interim, you can feel free to interrupt me. So the reason why the title of the talk is How Not to Find a Great Business is to take what is known as the mental model of inversion. So you in this room will all know who these two people are. On the left-hand side with the blue tie is Warren Buffett, and on the right-hand side with the red tie is Charlie Munger. So the concept of inversion is actually a Stoic philosophy, and it was explored by the writings of the Roman Emperor Marcus Aurelius. He was actually a battlefield general, and he lived from 120 to 180 AD, so obviously a very long time ago. And he basically proposed that instead of thinking about how to win on the battlefield, we should think about how not to lose. That's what the mental model of inversion is. And Charlie Munger basically did a modern play on that, the modern interpretation of it. And he put it this way: invert, always invert. Turn a situation or problem upside down and look at it backwards. What happens if all of our plans go wrong? Instead of looking for success, make a list of the things that will make us to fail, such as sloth, envy, resentment, self-pity, entitlement, all of the mental habits of self-defeat. And if you avoid those qualities, then you will succeed. If anyone wants to read the whole book, it's called How to Guarantee a Life of Misery, which is a really uplifting title. So first off, I'll give you a little bit of background about myself. So as David kindly said, I've got 15 years of experience in the financial services industry. I'm the founder and managing partner of Loh-Gronager Partners, and we're an investment partnership based out of London. And I run our global fund, so I'm essentially the chief investment officer, and I'm responsible for all of the investment decisions. I'm half Danish, but was born in the UK, educated in Europe, Asia, and Australia, so I have a bit of a mixed background. And as I said in the introduction, I studied at Durham University, and I studied accounting and finance. In terms of my career, I started with internships in sales and trading at Goldman Sachs and Swiss Re Asset Management. I then moved to be an interest rates trader at Morgan Stanley, so very much the macro side of the business. And from there, I moved to be a credit trader at Credit Suisse. One of my colleagues at my fund says that you haven't had a career in banking until one of the banks you've worked at has gone bankrupt. So my badge of honor is Credit Suisse, who's now taken over by UBS. So that's very much the micro side of the business. So that was looking at the income statements, balance sheets, and cash flow statements of individual businesses, and working out where within that we would deploy our own capital within that capital structure. And then from there, I moved to be the chief investment officer for a UK-based family office. And that's essentially where I came up with the strategy that we run today at our investment partnership. I'm also the author of a book called The Perceptive Investor, The Art, Science, and Temperament of Successful Value Investing. And the purpose of writing the book was to demystify the investment journey as well as the investment landscape through my own experiences. I wrote it in conjunction with the Financial Times newspaper, and they have a charity called the Financial Times Literacy and Inclusion Campaign. So all of you that go into finance eventually got to be really comfortable with acronyms. They're called FT Flick, really imaginative. And essentially all of the proceeds from that book are being donated. So I have a signed copy today for whoever asks me the best question. I usually do this because this normally encourages someone to ask at least one question, because then you're guaranteed to get the book. In terms of our investment partnership, as David said, we started our investment partnership and we based it on the principles of the original Buffett partnerships. So before essentially taking control of Berkshire Hathaway, Warren Buffett essentially ran his own hedge fund, and they were called investment partnerships back in the 1950s and 60s. And that's the style under which we put or frame our fund today. So we're concentrated long-term value investors looking to partner with exceptional businesses. We have a global portfolio of roughly 30 holdings, but despite that, each of our holdings do have several things in common. So the most important is strong growth potential, they have widening economic moats, and they're run by high integrity management that think like we do as real business owners. When I do investor presentations, investors always ask me to describe our investment philosophy, and normally at that point you get given 100 pages about how that investment manager manages money. I actually think that a picture can be worth 1,000 words, which is why I've got the painting here, which is called La Clairvoyance by the Belgian artist René Magritte. Please come in. And it's widely known as perception. And the reason for that, once I explain it to you, is quite obvious. So what you've got here in the picture is you've got the artist pictured seated, and he's looking at a stationary egg. And yet what he's painting on the canvas is a fully grown bird in flight. That's the power of perception. And that is what we do. We're trying to look at all the publicly available information available regarding a business and projecting forward a different outcome from that the market can currently see. For those of you that are not 100% familiar with what a hedge fund is and what the hedge fund industry is more generally, the term comes from Alfred Winslow Jones, who was widely regarded as the founder of the hedge fund industry. And essentially he came up with a strategy to go long a basket of stocks that he thought were going to go up in value, and conversely against that, short a basket of stocks that he thought were going to go down in value. And that's where the term hedged fund comes from. We'll go through this. There are now an absolute plethora of different investment strategies, but the fundamentals of how a hedge fund works haven't changed since then. So essentially you have a group of investors that combine their capital and pass it over to the hedge fund manager, who pools that money and then invests it into a portfolio of various different assets to achieve a specified rate of return that would be compensating the investors for providing the capital to the fund manager, on which he usually charges a fee. So the hedge fund industry itself consists of about 10,000 hedge funds at any one time. Interestingly, the average hedge fund only lasts for 4 years, so very, very high turnover. And they manage about $4 trillion of assets in a plethora of strategies, everything from convertibles arbitrage to macro trading, or to what we do at my partnership, which is at the bottom there, 6% allocation in the industry, hedge fund long only. So now coming on to the topic at hand then, how not to find a great business. I thought the best place to start this was to explain the investment process and then show you where we're talking about. So this is the investment process that we operate at my investment partnership. And I think the best way is to show it with the diagram on the right. So it's an inverted funnel. So some people say to me, well, why is the funnel inverted? Well, the truth is, as value investors, we're bottoms-up stock pickers. So the widest part of the funnel is at the bottom because we're bottoms-up. There are 3 steps to what we call the security selection process at my fund. So the first is how do we source the investment ideas? And that's what we're going to talk about today. The second is how do we evaluate the potential investments? And all of the parts within that stage are designed to test what's the margin of safety around that business. What's the discount to intrinsic value that we can buy it at? And the final stage at the top there is the investment decision. Are we going to buy it if it's a newer investment idea? Are we going to sell it if it's a current investment idea that no longer meets our investment criteria? Or are we going to continue to hold it if we still think it's an exceptional investment? So I've come up with 4 rules as to why or how not to find a great business. And the first rule, rule number 1, is to not define your investable universe. There are 45,000 listed equities globally. So to source your investment ideas, you're going to have to narrow your funnel. And the first way to do that is to define your investable universe. And there are lots of different ways of doing that. And I think that this is where temperament comes in. You have to work out what you're comfortable with and what sits within your circle of competence. So I've given a couple of examples here. So geography. So you could decide that you're a developed markets investor or you're an emerging markets investor. You could say you're a country-specific investor. I only invest within the US, so therefore my investment universe is only roughly 4,000 companies instead of 45,000. You could do by sector. If you've got a speciality, an area that you're more interested in, healthcare. Logistics is probably unlikely, but healthcare or financial services maybe is more. Business model is another way of doing it. So you might be like, I'm very comfortable investing in franchise businesses. An example would be McDonald's. Or subscription-based businesses, Netflix, things that we all use. Another way would be to look at it based on an index. So you might say, I'm only going to invest in businesses in the S&P 500. And that way we're narrowing our investable universe to a more manageable subset of those 45,000 listed businesses. The second rule is don't have a screening process. So this links in with the first stage, which is if we've got 45,000 listed businesses and we want to attempt to narrow that universe down to a more manageable selection, even if we narrow it down to, say, 4,500 companies, if we say we're only investing in the US, how do we narrow that down further to a subset that is manageable for us to do a deep dive into? So one way of doing this is screening. So screening is powerful, but it also has significant limitations. We're looking for diamonds in the rough if you're managing a concentrated value portfolio. And screening is a difficult method for ascertaining those businesses. So what I like to do, or what we do at our firm, is we do multiple levels of screens. Because some businesses will make it through one, not through another, but then through a third one. And you essentially have to use your knowledge and your experience to decide which of these screens is more important, relevant to that business. So you can screen, I basically break it up into two different types. So there's got quantitative screening and qualitative screening. So quantitative screening is obviously relatively straightforward because we have all the financial metrics for all these businesses that are listed. So it's much more straightforward. Qualitative screening is slightly harder, and we'll go into why that is in a second. So if we start with quantitative screening, we might do that based on valuation. So you could do a price to earnings, price to sales, price to book ratios. So you might decide that you're looking for particularly cheap businesses, so businesses that trade below price to earnings ratios. Another would be, and one that I'm an advocate for, is anti-fragile businesses. So I like to try and find businesses that have no debt, because the one thing that introduces fragility into a business model is leverage. And it goes the same with your investor portfolios. In general, it's very hard for a business to go bankrupt if it doesn't have debt. I'd say pretty much every business goes bankrupt because it can't meet an interest payment on its debt. It's usually the reason why. Growing businesses. So for us, when I explained to you that all of our portfolio businesses have several things in common, growth potential is quite important for us as part of the value equation. So therefore, we might want to find businesses that have a reasonable level of revenue growth rate or high earnings per share growth rate. Another is strong moats. So we want moats around our businesses. We want businesses that we can invest in for the long term that are going to be here in the future. So what's a way of testing for that? Well, one way of testing is margins. Gross margins, operating margins, net margins. We want to see consistency in the margins because margins tend to be sticky. We also, if we are going to see a trend, we want to see an upward trend rather than a downward one. And then value created. There's no point in a business that doesn't create value. So there's ways of measuring that, return on invested capital or return on capital employed. Then when it comes to qualitative screening, this is slightly more subjective, and this is why I think it's a bit more interesting. I think this is slightly more unusual compared to some other investors. So one question I always like to ask is, are management good capital allocators? The management team of the company we've invested in are technically, they work for us. Their job is to manage the capital we've given to them in the best interest of us as the long-term shareholder owners of the business. So their capital allocation skills are absolutely key. And there are various different ways we could screen for that. So when a company makes an acquisition, it has to write up goodwill in its balance sheet. And what we can essentially see here is if there are write-downs to goodwill over time, that might indicate that actually the management team are not good capital allocators because they're making acquisitions and they're overpaying for them. So that might be a way of doing it. Another way is looking at the dividends and buyback track record of the management team. Are they buying back stock when it's undervalued and then the share price goes up, or are they actually just consistently buying stock regardless of the price? Which one would say, unless the stock is incredibly cheap, might show that they don't have the best use of capital. And another question here is, do management think like owners? I said in the introduction, we want management teams that think like ours, like owner-operators. So there are ways to test for that. Are they large shareholders in the business themselves? Do they do capital raises, which usually are done, depending on when they're done in the cycle, a capital raise is usually done when the share price is really low and the business is in trouble. That's usually very dilutive to shareholders, which is obviously not the right time we want them to be doing it. And share dilution more generally, how are they compensated? Are they paying themselves really large stock compensation packages? And there are examples where that is a positive, and there are also examples where that is a negative. I'm happy to go through those during the Q&A. So the third is don't have multiple methods for idea generation. And I think this is what's really important. You know, we talk about screening, we talk about narrowing the investable universe. That sounds quite scientific, it sounds quite quantitative, things that we can really wrap our hands around. But actually, I think you need to have a lot of flexibility when it comes to your investment process, in terms of you need to have lots of ways for ideas to come into your funnel, outside of potentially what you're narrowing the funnel down to. And I'll just give them 3 examples here. If you come to my office in not far away from here, we've got a couple of copies of these. These are the Moody's manuals. Has anyone seen one of these before in person? No one's seen one. So Warren Buffett, when asked, how do you find great businesses? He says, start with the A's. And this is actually what he means. These books are 3,000 pages per book. They publish 12 and 2 sets of them every year. And that's what Warren used to flick through to find his great investment ideas. So he was going through 36,000 pages twice per year. And they're listed alphabetically, A through Z, which is why he said start with the A's. And he also said that all the good ideas are almost always towards the end. So that's like volumes 10, 11, and 12. So it requires an enormous amount of patience to go through all of those to be able to find great ideas. Another example would be cloning. So I think we're taught a lot in school that copying is wrong. That if you copy someone's multiple choice questions on a test next to you, it's wrong. And in that context it is. But in financial markets, it's not. All of the best ideas have already been discovered in financial markets. They're already publicly listed, unless you're buying a new IPO business. So on that basis, there are already people that have done the research and identified these as exceptional ideas. So what I've given you an example of are some very important dates. February the 14th, May the 15th, August the 14th, and November the 14th. And those are the deadlines for investment managers that manage more than $100 million of US securities. They have to every quarter update the US Securities Commission, the SEC, with the positions that they own. So if you can find exceptional investors with exceptional track records, it might be worthwhile looking at their holdings on a quarterly basis and seeing if you can reverse engineer why they might own some of those ideas. That's the idea of cloning. And finally, the media. So I actually find that most of my ideas come through this method. Newspapers, trade and industry journals, investor forums, and conferences. It's not as important to me who tells me the idea, whether it's from the Financial Times or the South China Morning Post or from an industry conference on lithium mining. Not very important. It's more that the idea percolates in my mind and I'm like, you know what, I want to do a bit more research on that, so it's going to go into my investment funnel and then move down through to the quantitative and qualitative analysis that we do. And then the 4th rule is don't have an override. So intellectual flexibility and curiosity, I think, are absolutely key if you want to be successful as long-term investors of any sort. Intellectual curiosity is the fact that you're always looking for new ideas. You're always interrogating your current holdings to see if your investment thesis about them is still correct, despite the fact that new information comes available on basically a daily basis. And the best investment ideas here, I've said, can come to you from the strangest of places. So I thought I'd give you 4 examples of where I've come up with sort of maybe esoteric investment ideas. So the first was investigating industry supply chains. So I read in the Financial Times, I think it was, and it basically said that everyone's going to drive an electric car in the future. So that led me to think, well, is there any way that we can profit from that if that turns out to be true? So you could immediately go and buy Tesla stock if you wanted to. Or you could maybe look at the supply chain for electric cars and see where the value is in that supply chain. So you might end up in China. You might be looking at CATL or BYD, who provide the batteries. Or in my case, you went a little bit even further down the route. So the batteries obviously have to have materials that go into them: lithium, iron, sodium, main sort of drivers of some of these batteries. And I ended up all the way at the Bolivian salt flats at a lithium mining conference, because the Bolivian salt flats, believe it or not, have the lowest lifting costs for lithium in the whole world. They're also totally unexploited. So I thought that's an example where you can go right down the rabbit hole of investment ideas. We actually didn't invest in a Bolivian salt flat lithium mining company. There are none that are publicly listed, but that's just an example of where you can get these ideas and you can end up going down a rabbit warren. Job listings. So job listings is an interesting one. So especially in countries where it might be hard to find a lot of data or a lot of information, maybe language barriers, so Japan is an example here. There's a Glassdoor, I think it's the UK and US version, and essentially I go through Glassdoor quite regularly, and there's two reasons why. So one is I like to look at what do employees say about the companies they work for. I think it can be usually quite helpful, and it's usually one of two extremes. You either love the company, because that's why you can be bothered to write a review, or you absolutely hate the company, in which case that's why you're writing a review and you're probably fired. So you've got to take those two sides and come up somewhere in the middle. And the second one is job listings. So what I found a Japanese company that was looking for a significant number of engineers from the US, from 3 universities, very technical universities. And I was surprised at the numbers. They're looking for hundreds of engineers. And it just perked my curiosity. So I went and did a bit more research on the company. I found that they essentially sponsored courses at 5 of the biggest universities in Japan on very technical degrees. And what it sort of led me down to was the fact that this company was massively increasing its R&D spend because it thought that it had found a new way of utilizing lasers to do with semiconductor chips. And that was how I found that investment idea. Another is patents. So patents are registered in Europe at the European Patent Office. We have a patent office in the UK, and there's a very big one in the US, where the majority of patents globally are registered. So looking on that register to see what companies are registering patents, how many, what are they about, can give you a bit of insight again into R&D and growth. We're looking for companies that are putting moats around their business. One great way of putting a protective moat around your business is R&D. It's through having patents that protect your technology. And then final one here, luxury goods. So this was actually an example of a business where we didn't buy it after I went and saw. So you would have thought, so there were a lot of articles around the time, it was in the start of last year, where they essentially said luxury goods were going to come booming back. All the big luxury goods stocks, LVMH, Richemont, that all rallied at the start of last year. And I was reading that, and I was like, that's interesting. So, essentially the demand for consumer goods in developed countries is relatively static to growing. So we have more rich people every year that want to buy an Hermes Birkin bag or an LVMH handbag, right? But the real growth for these companies is coming from Asia. And what a lot of people were doing is they were just looking at the luxury goods company shops in Europe, UK, US, and being like, there's queues outside LVMH, Louis Vuitton. So clearly the demand is going to be there. Without taking the second level of thinking, which is, well, demand is relatively static here because there are so many people that can afford these bags already. The growth is in Asia. What are the queues like in Asia? So I actually jumped on a plane and I went to China. It was part of my research trip that I was already going there for. But I decided to incorporate a couple of extra cities. So I went to the 6 biggest cities in China during the course of a 6-week trip. And I essentially just went to every Louis Vuitton store, every Tiffany store, at all the big shopping malls to see, well, what are the queues like? And this was March of last year. April is when the first quarter earnings came out. And in March, I can tell you there were no queues whatsoever outside any of the stores. So I just messaged my team and I said, I think that the media has got it totally wrong in the West. We seem to think that just because there's people queuing here, it means there's people queuing over there, and it's not the case. And then the first quarter earnings came out in April last year, and you'll have seen LVMH and all the rest of the stocks all sold off, all the gains they'd had for the year, because actually the Chinese consumer wasn't buying. So I think that what that also shows is intellectual flexibility and curiosity are key. Can't believe everything you read. Boots on the ground, doing your own research are very, very valuable and very important. So in terms of a summary of how not to find a great business, I'd say don't define your investable universe. Don't focus on areas that you know are within your circle of competence. Don't have a screening process. Don't sift through your investable universe using diverse screening metrics on both a quantitative and qualitative basis. Don't have multiple methods of idea generation. Don't have a variety of methods for increasing the number of ideas that are coming through your investment funnel. And don't have an override. Don't remain flexible and intellectually curious in your search for great businesses. And then, most importantly, don't remember the famous words from Buffett. Your goal as an investor should be simply to purchase at a rational price, a part interest in an easily understood business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. Over time, you will find only a few companies that meet those standards, So when you find one that qualifies, you should buy a meaningful amount. And with that, I'll close. I'll say thank you very much for listening to me. I hope some of that was of interest to you, and very happy to answer any questions that you might have. Sure.
So my question is regarding the value investing strategy itself. So over summer I read a book, I don't know, you probably know from Charlie Munger, it's like a little book that beats the market.
Yes.
And in that he basically doesn't really critique Benjamin Graham, the intelligent investor, but he basically points out that the problem with the intelligent investor nowadays is that the method that he used post the Great Depression and post World War II isn't applicable to value investing in today's world. And he mentioned how important it is when you do value investing, but how important it is to be adaptable in value investing itself. And even now, if you look in the 2010s and the kind of the tech boom, that a lot of value investing hedge funds didn't have as good returns as long-short equity funds because the market wasn't really right. What is your view about like how adaptable one should be when doing value investing, and how to look at the approach and from a different angle when actually doing value investing?
Appreciate that question. If no one else asks a question, then you get the book. So I do have a slide a little bit further on, which I think goes a little bit more into what you were saying there. So what is value investing? So in my opinion, all investing is value investing, where we're seeking to buy an asset for less than its intrinsic value. If you're not trying to buy something for less than its intrinsic value, you're gambling. It's quite straightforward. And as you alluded to there, evolving your investment process over time is super important. If you're entirely fixated on the investment outcome, that's where a lot of investors over multiple decades get tripped up, because markets evolve and markets change. So if you take traditional value investing, that was practiced by Ben Graham back in the Great Depression era, and he advocated buying a large portfolio of businesses, had 50 to 100 stocks in his portfolios. And he was essentially buying what are known as dollar bills for 50 cents, or net nets, or cigar butt investing. So he's trying to buy businesses for less than the liquidation value. So that if the business does go out of business, he can sell those assets and pay himself back and still make a good return. That process sort of evolved with Phil Fisher. And Phil Fisher is essentially the father of what we might call growth investing. And he said you should purchase a concentrated portfolio of businesses that have compelling growth prospects that you understand really, really well. So totally different from what Ben Graham was preaching in roughly sort of a tangential era. And what Buffett has done is essentially combined the two into what I call modern value investing. And that's where we're trying to buy great companies at fair prices. And in Buffett's case, where feasible, he buys the whole business. And we want a concentrated portfolio, but that operate in a diverse range of sectors. So for us, that's global diversification, sector diversification, business model diversification. And to your point, we are entirely focused on evolving our investment process over time, because that's the only way we're going to have longevity in the business. And I think Buffett shows it really well, because if you look back at the year 2000, when the dot-com boom and bust happened, everyone said Buffett was a dinosaur, that he was way past his time, because he kept saying, I'm not investing in things I don't understand, I don't know why pets.com has gone up 500%, I don't understand Amazon, I don't understand Google, and Berkshire Hathaway's share price halved in the year 2000, when all those companies went up hundreds of percent. Fast forward to 2021, most of those businesses have gone bankrupt, or their shares are down 95%, and Berkshire Hathaway's stock is up like 200%. And then if you fast forward from there to 2012, the biggest investment that Buffett ever made in terms of the return generated in dollars was Apple, which is quite amazing when you think about it. So in 2000, he wouldn't ever have thought of buying Apple stock. It was totally outside of his circle of competence. And the story he tells is that he was in a Wendy's. I don't know how many of you have actually been to a Wendy's. It's kind of like a terrible burger shack in the US, in my humble opinion. I think Five Guys is much better. Buffett owns Wendy's via Berkshire Hathaway. And he said he was taking some of his grandkids there to eat, and he noticed that every single person that he looked at in Wendy's had an iPhone. And he was like, maybe this is not a technology company. Maybe this is a consumer goods company. I understand consumer goods. Therefore, I'm going to do a bit more research on it. He ended up buying a $10 billion position in Apple, which ended up being worth $120 billion, which I think even to this date is the biggest stock market return for any individual investment that anybody really knows about. So that's an example of evolving your investment process over time. Buffett's 96. All of us can do it. Thank you for the question. Sure.
How much do financial models and technical analysis play a role in your investment process? Like say when you're entering or exiting a position?
So I'll just go back to the investment process that we use at my firm. And what you'll notice from this slide is essentially the complete absence of that. We don't use any technical analysis. So I genuinely do not care what the stock price does on an interim basis. I have stock price alerts set on the portfolio. If there's a plus or minus 10% move in an individual position, that normally means a piece of news has come out that's obviously significant to the business. But the way I interpret that is a bit different from how you might expect. My alerts don't tell me whether the stock price went up or down. They just tell me that it's moved by 10%. I then get the associated newspaper article, and then I'm going to read the article and decide when I read it, do I think that the share price should have gone up or down? And it will surprise you that actually half the time I'm wrong. Because what I think is good news for the business, the stock market might think is bad news in that short interim period of time. So that allows me to be a contrarian investor. Because if I get a piece of news and I'm like, oh, that's interesting, BYD's car sales have hit a record, the shares have fallen 12%. That doesn't make any intuitive sense to me, other than the fact it might mean that the market got ahead of itself and thought the numbers would be even better. So then I compare that to my investment thesis, which might be, well, what was my extrapolation of how well I thought BYD's sales would be over the course of this year or next year? And if the trend is exactly as I'd expect, maybe it's an opportunity for me to be buying more. So that's kind of how I think about like interim or short-term moves in the share price. There are some investors that pay a lot of attention to resistance bands and 40-day, 60-day, 100-day moving averages. But for us, as long-term value investors, what I really care about is the intrinsic value of the business. I'm much less interested in what the stock price does in the short or interim period. I'm much more focused on the business. So unless the fundamentals of the business have changed, and that's affected the share price, then I'm interested. If the share price is moving and the fundamentals of the business remain the same, much less interested, unless it's a potential opportunity to add. Thank you. Sure.
Hi. So I think Buffett and Munger like to talk about the importance of circle of competence, but I just want to ask, like, as a 20 years old or 21 years old, how do you grow your circle of competence? Because, like, by definition, when you're 20 years old, you have no circle of competence, right? I think this is a very much not talked about topic.
I think it's a really good question. It sounds really straightforward. Circle of competence. What's in your circle of competence? It's actually quite a hard question to answer if I ask you pen and paper, write it down. Because I'm asking you to write down what you believe you thoroughly understand. And I'll posit to you that actually none of us really know very much about anything. So on that basis, you have to be quite skeptical when it comes to, in my opinion, what sits within your circle of competence. I usually say that you should let your curiosity drive you when it comes to your circle of competence. But there's always a way to start. There's always a place to start. So you're using an Apple laptop. There must be a reason why you bought that over, is this a Dell? Asus. Why you bought an Apple over an Asus?
Because I think I like the iOS operating system, the macOS operating system.
So you might therefore have identified a moat around Apple's business. You've bought it because you think it has a superior operating system. So that would be an example where you're the user of a product and you've actually already potentially identified part of their moat. And so I think that one way to start your circle of competence is actually to look at what do you spend money on? What do you buy? If you go through your bank statement and you see all your outgoings, who do you pay? Netflix, probably. Apple, maybe every so often. But then you probably have, a recurring £10 debit from Apple for their cloud storage. Do you go to the shop? Which shops do you go to? Or do you buy on Amazon? And why do you buy on Amazon? Is it convenience or is it price? Or is it a mixture of the two? So I think the best place, if you're wondering where your circle of competence starts, is probably to start with things that you know, things that you understand, things that you're a consumer of. Because you're more likely to understand what is the moat around that business. Because you're going to have to sit there and think, why did I buy that? Why do I use that product or service? Like, why do I keep my Netflix subscription? Even if I've watched everything on there for the moment. Well, it's probably because you think they've got more content coming. And so you're sticky, despite the fact you could cancel your contract. And then the question being with Netflix would be, well, when they increase, which they do seem to do every year, they increase the price of the subscription. So did you ever stop to think to cancel yours? Or do you actually think that actually at £10, £12.50, £15, £20 actually doesn't make a difference per month because you value the quality of the service that it provides to you? So I think that's quite a good place to start with circle of competence. And then when it comes to growing it, I think when I was talking to you earlier, I gave the 4 examples like the living salt flats, luxury goods companies when I went to China. Like all of this comes from curiosity. And I think that's a really good driver of circle of competence. What are you curious about? What interests you? When you read the FT, when you went read the whole newspaper, what article stuck in your mind that you want to read more about, do more research on? That's how you build your circle over time, because it's curiosity that drives that. If I ask you to, research a logistics company, you might find it really boring. It might not be a comfortable fit within your circle of competence. If I ask you to do research on Apple, you might be really keen to do that because you'd be like, oh, I want to learn more about my own behavioral traits. Why am I willing to spend £1,000 on a laptop when the Asus costs half as much and does essentially the same job? So those sorts of ways of framing things, those ways of thinking, I think they're quite powerful. And I think that's the best starting place for growing that circle over time. And I think everyone's circle changes as they grow, as they experience more in the world. To your point, as you get older, get more wise, experience more things. But you can accelerate that through curiosity, which is reading more, exploring more, seeing what other people are doing and trying to learn from those experiences. Sure.
I had a question on, so like first, when you're first opening a name, like what do you do to ramp up on the name? And then like how do you decide how to allocate your time as well? Because that's probably one of the most precious things you have in research.
Sure. So I'll go with the first question to start with, which is we have 2 types of positions in my fund. We have what we call our full positions, and then we have watch list positions. So this also comes to knowing your temperament as an investor. When I look back at my investing track record, it would be significantly better, as with all of yours, I presume, because we can all look at things that we didn't invest in that have gone up a lot. And I think one of the important things is to work out why. Why did we have those errors of what you might call omission? So they're not errors of commission, which means you bought something and it went down. They're errors of omission, because you saw something but you didn't buy it and it's gone up a lot. So for me, a lot of it came down to valuation. There have been a lot of what I've recognized as what I think are exceptional businesses, but they've been trading at what I thought was too expensive a level. So that's why we have watch list positions in my portfolio, which is generally, not always, but generally because I found what I think is an exceptional business, but I think it's too expensive. So I started as a 1% position in my portfolio. And the reason for that is my past experiences. If I don't buy any shares in that business, it will inevitably go up. And when it gets even more expensive, I definitely won't be buying any. So at least that way I get more comfortable with the business and the valuation over time and might increase it to a full position. So for us, a full position in our portfolio is about 4%. So we have roughly 30 positions in our fund. And at 4% weighting, and we equally weight all the positions, so it's either a full position or a watch list position. We have roughly 10 watch list positions. So the remaining 90%, roughly speaking, is those remaining sort of 20 positions. And within those, they're all equally weighted. And the reason for that is we don't ramp up, ramp down. And the reason for that is the fact that I'm a believer, a strong believer, that we let the market tell us whether we're right or wrong. There's a really interesting book called The Art of Execution by a guy called Lee Freeman Shaw, who you should definitely invite to come here and give you a talk. So he was a fund manager at a fund called Quilter Asset Management. And essentially he gave money to sort of 10 exceptional managers. These guys all had great track records. They all outperformed the market over time. They were all doing the same thing. They were long-only equity stock pickers. And what he basically said was, he was like, he looked at their portfolios over time and he realized that almost all of their positive returns came from 1, maybe 2 positions in the portfolio on an annual basis. So Freeman Shaw had what he thought was a great idea. He's like, you know what? I'm going to ask each of these portfolio managers just to tell me on the 1st of January, what's your best idea? What's the idea you have the most conviction in? And I'm going to put that into a portfolio of the best ideas fund. And I'm going to raise a ton of capital because everyone knows that these portfolio managers outperform. So if I do a best idea fund of those portfolio managers, we're bound to outperform even more massively. So he raised a couple of $100 million, started the best ideas fund. That fund went for 3 years before it went out of business. It massively underperformed the market. And the reason why it underperformed was the fact that none of these portfolio managers could ever accurately predict which of their portfolio holdings was going to be the best performer. their highest conviction ideas tended to be the worst performer, interestingly enough, and their least conviction ideas tended to outperform. And it's an interesting quirk of human nature. The other issue that there was with the portfolios was that once a portfolio manager said, this is my best idea on the 1st of January, they refused to change their mind, despite new information coming through, because they'd had to put their hand up, which is confirmation bias, and they've stood in front of a room and said, this is my best idea. So when it goes down 50%, it's still my best idea. New information has come out and says this business isn't a good business anymore. It's still my best idea. Because it's very, very hard if you declare publicly that something is your best idea to change your mind in 3, 6, 9 months. Confirmation bias. So that's one of the reasons why we don't ramp up or ramp down. We have essentially, normally we have a roughly 5-year holding period. And during that holding period, either that position is going to go up massively in our portfolio, the market's told me that I'm right, or it's going to go down massively, in which case I'm clearly wrong. Now obviously, if new information comes available about the business that disproves our original investment thesis, we're going to sell it before it's been in the portfolio for 5 years. So my job, essentially, coming to your second question, what do I spend my time doing? There's 2 sides to it. One is I'm constantly evaluating all of our portfolio holdings on any new information that comes available to see if my investment thesis is still intact. Because what I don't want to do is there's a strong cost of capital. If I hold a business in my portfolio for 5 years and it roughly flatlines for 5 years, I could have taken that money and invested it in another business that did significantly better. So on that basis, I need to be constantly reviewing the positions. Then the other side of my job is to find new exceptional ideas. But if we're trying to have an annualized portfolio turnover ratio of about 5%, I only need 1 or 2 new good ideas per year. So I can turn over a lot of rocks to try and find what I think are those 1 or 2 exceptional businesses. So I thought there was a question, unless I already answered it, in which case.
Of course, I'm a capitalist as well, so I do believe in the markets, and I believe that markets are able to be efficient by themselves, okay? But I kind of also sometimes, still studying here now, I do believe in the Keynesian approach, so kind of depends from every situation and every moment in history, okay? And what I find really interesting is that you just told that you believe that the markets are able to tell you whether your investment strategy, broadly speaking, is right or wrong. Very interesting. But then my question would be, how can you trust the markets now in this moment of geopolitical chaos, which is also kind of touching on, at least I would say, 2 out of 3 of your methods for idea generation, so cloning and media. So for instance, how can you also trust the media? I mean, I'm sure you write the FT and then you listen to Bloomberg and whatever, but how can you trust it all to develop your, one approach to put it into a strategy and execute your strategy? I don't know if my question makes sense to you.
I'll try and answer what I think the question is, and then if I haven't answered it, you can ask another one. Okay. So taking the second part first, I don't believe what the media puts out, in general. I'm naturally skeptical. The media as a business model is there to sell newspapers and deliver eyeballs on screens. All the headlines in general have to be quite sensationalist. So if they say, stock market collapse when it's fallen 3% the S&P in a day, it normally gets people to look at the article, in which case that journalist gets a good review, high ranking in Bloomberg, etc. So you have to be naturally skeptical. My point of the media as a source of investment ideas was coming from the curiosity perspective. Whereas what I'm saying is if you read Bloomberg or you read the FT or you read a trade or industry journal about lithium mines or I don't know, batteries, what I'm trying to say you should embrace is, with your curiosity, is try and read those articles or read those newspapers or those media outlets and try and see where's your attention pulled. Not necessarily in terms of individual names. I'm not reading the FT because I want to learn more about Nvidia stock. But I'm curious then about the semiconductor industry more generally. Where in the supply chain might there be value? Where might there be undiscovered value investments within that supply chain? So I'm not necessarily looking at the media to give me good stock ideas. I'm looking for it to trigger my curiosity on a certain topic and therefore me want to do a deeper dive into it. If Bloomberg says Nvidia stock is cheap, that means nothing to me. But if it talks about Nvidia stock more generally in the context of semiconductors, that might be quite interesting to me. In terms of, as I said, the source of the idea is not very important. So if Bill Gates tells me that Microsoft stock is a good buy, you might say, well, you should probably attribute a bit of a higher weighting to it because he knows more about that business. And I'd say, yeah, arguably yes. But how much does Bill Gates actually know about the whole IT industry? How much does he know about US equities versus global equities? How much does he know about developed markets versus emerging markets? So from that perspective, if Bill Gates gave me an investment idea, it goes into our investment funnel without his name next to it. The same way that if you gave me the idea today, for example, we're talking about your Apple computer, if I leave this presentation I'm thinking about Apple stock, it will go into our investment filters as Apple stock, but I won't put where I found that idea from, because to your point, it shouldn't really matter. I shouldn't be skewed by the source. And then, the first part of your question, which was sort of, as I understood it, market efficiency. I think markets are it's interesting, I think there's a range. You could argue that markets are really, really efficient in the very, very short term because of high frequency trading. But then you would say, well, how do high frequency trading firms make billions of dollars of profits if the market is efficient, even in the very, very short term? Hard question to answer. But what I would say is, as you increase your investment time horizon from millisecond to second to minute to hour to day to week to month to year to 5 years to decades, as you increase your investment time horizon, the inefficiencies become larger and larger and larger, the opportunity to profit. And that's essentially what we call time arbitrage. The narrower the time window within which you're investing, like if your objective is to make a huge amount of money today, you're competing with a hell of a lot of people who have got enormous amounts of capital in that area, that arena you've decided to compete in. In the arena I've decided to compete in, which is basically a 5-year investment time horizon, I've got a lot less competition. Most people don't have the patience to do what I do. Most people are put off by the gyrations, coming back to that question earlier about technicals, about what the stock price has done. That doesn't align with my temperament. If you tell me that my stock portfolio is done, I couldn't actually tell you what our portfolio has done today. Now, there'll be a lot of managers that will come in here and they can literally pull it up on their phone, they can tell you immediately how much money they made today or lost. I can't do that. And that's deliberate, because that affects my decision-making process. Why do I care what the stock has done on a second-by-second or day-by-day basis if what I really care about is how is the business valued in 5 years from now? So there are members of my team, by the way, just so you know, that are aware of what the stock portfolio does at all times. So if something terrible happens, I will get a phone call. But for me, for the decision-making process, it's quite important. So I think if you want to capitalize on opportunities in markets, if you increase your investment time horizon, you increase your time arbitrage, there's an opportunity to make very high returns because you're competing with a lot less, the subset of people you're competing with is significantly less. And I do think that markets tend towards efficiency, especially over long periods of time. So a business that you discover that you think is undervalued, I would argue that 5 years is some people would say quite a generous time horizon. Ben Graham, who we talked about earlier, he had a 3-year time horizon. So if that net didn't increase in value within 3 years, he sold it. Buffett generally said his was about 4 years, mine is about 5 years. And I think that if the value of the business, that discount to intrinsic value that you perceive, hasn't materialized during that period of time, I'd say you're probably wrong. Now that's not going to be the case all the time. There are great examples of businesses like Microsoft. If you bought Microsoft in the year 2000, you lost 75% of your money and Microsoft stock did nothing for the next 10 years. But actually for the following 10 years, so 2010 onwards, it's one of the best performing stocks in the stock market. And if you take it from IPO, it's compounded like 23% per year for 35 years. One of the best returns ever. So there are, even for incredible businesses, fixed periods of time where they underperform. And it requires temperament, it requires patience to be able to sort of live through those periods of time. Thank you.
Thank you.
I'll take
Do you think there's a way that your company can adapt their investment approach to ensure more sustainable growth? And if not, what do you think actually differentiates your investment process to another company's?
When you say sustainable growth, you mean in terms of environmental, social, and governance?
No, so obviously value investment. You say you usually invest for 5-year periods.
Yeah.
Because you're looking for more long-term growth.
Yes.
Do you think there's a way to like make your investment process better to ensure like that long-term growth is actually there?
I would say immediately yes, there's definitely going to be ways that you could improve our investment process. And that's why we're constantly evaluating it and trying to constantly evolve it. I think if you're thinking about growth I've learned comes in lots of different forms. So there's good growth and there's bad growth. So you can have growth of quantitative metrics within a business that make it look very appealing. So for example, you can offer very heavy discounts on product to suppliers or to retailers, and they'll sell a lot more of your product. Your revenue numbers will look a lot better. Your growth in the short term will look a lot better. But that comes at the expense normally of future growth down the line. So what I call that is front loading. Pardon me. And you see that with certain businesses, and that's actually a red flag for me. Because that means the management team are not focused on the very long term. They're really just focused on this quarter or this year. And actually for us, you know, we're probably going to be investors in the business longer than the CEO is there. I mean, interestingly, that the average hedge fund only lasts for 4 years. The average tenure for a S&P 500 CEO, I think, is about 4 as well. So they're normally not around very long. So they're usually there to try and get paid as much as possible. And their compensation is usually, a lot of their compensation comes from stock options, which are usually based on what does the share price do. And the fastest way to get the share price to go up is to show growth in earnings per share. And the fastest way to do that is normally to sell a lot more of whatever it is that you sell. And there are lots of ways and tricks and means of doing that to give you a short-term boost. But that always comes at the expense of the long term. So when I look at our investment process, I think one of the ways to ensure that the businesses within it have good long-term growth prospects is to be constantly evaluating the management teams of our portfolio businesses to make sure that they're aligned with us as shareholders, so they do own a decent amount of stock in the business, but they're not overly focused on earnings per share growth or the stock price. And one way to check for that, which we can all do, because we've all got access to it today, is quarterly and annual management calls. And you can just reference, you can use an AI agent to check how many times does the CEO mention the share price? How many times does he talk about hitting targets? And I would say that the more the management team are focused on those short-term metrics, the more of a red flag that is for me as an investor. And that's something that's been integrated into our investment process since we started our fund 3 years ago. Thank you. Sure.
I guess I'm curious, you said you have a 5-year time horizon. I guess I'm curious, most managers, they would suffer from like investor withdrawals if their thesis didn't materialize within a year or two. Because I'm curious how you've gone about like cultivating like an LP base that is willing to stick around for a multi-year period.
Yeah, this is a good question. So there are 2 sides to running a hedge fund. So one is you need to be an entrepreneur because you need to be able to run a business. That's what we are at the end of the day. And then the second is you need to be able to run an investment portfolio successfully. The main reason why most funds are only in existence for 4 years is because they can't do the former. They can only do the latter. So unless you're an entrepreneur, unless you love starting, founding businesses, going out and cultivating a subset of LPs that are going to invest in your fund, unless you can sell, you're not going to be a good fund manager. Fact. Because how are you ever going to raise any capital if you can't give a presentation, if you can't talk about what you do, if you can't convince other people that you're better at doing it than they would be? But you might be a very good investor, so you might have good portfolio returns. So one of the things that Buffett actually famously said was, he said, it doesn't really matter actually about being a good entrepreneur. He basically said if you could do good investment returns, you could be in a rowing boat in the middle of the Atlantic surrounded by sharks, and LPs will swim to you to give you money. I'd say that might have been true back in the day, but it's certainly not true today. There are lots of people that I know that have really good track records, but that run very little capital. They might only run their own, because they can't do the former. You have to be able to run a business. You have to be able to meet investors. You have to be able to network. You have to be able to convince them that you are going to be a better steward of their capital, or as good a steward of their capital as they would be. I'd like to say to our investors that we treat their capital as if it was my capital. We, the management team in my fund, are the second biggest investor. So we have what's known as skin in the game, which basically means as long as you're investing less money than we have invested, then if our fund goes down by 5%, it's costing me more money than it's costing you. So unless you're our one LP that has more money in than us, always we feel the pain more than they do. The other thing is we don't charge a management fee. So most hedge funds charge a 2% management fee and a 20% performance fee. We don't charge a management fee. We only charge a performance fee. And that goes back to Buffett's original model. And the reason for that is I don't want to get paid unless I've done a good job for you. In a way, that kind of sells itself. You don't pay me a salary. You entrust your capital to me. If I do a good job for you, I get paid. If I don't do a good job for you, you know that I've got more money invested in general in the fund than you do, so it's costing me more money anyway. I'm very incentivized to do a good job, but equally well, you're not paying for my time or for a salary for me or to keep the lights on. So in that respect, I think my business model, our investment partnership has a good moat around it. In a way, I kind of think of our business as one of our portfolio businesses. What are we looking for? Strong growth potential, widening economic moats, and a high integrity management team that think like business owners. So whenever I have a meeting with an LP and we sit opposite a table, I want to put myself in their shoes and never do anything or say anything that would make them upset if I was in their position. So when I sit across from an LP, they immediately go, oh, so you're the second biggest investor in the fund. Seems good. You're aligned. Yeah. Don't charge a management fee. Okay, that's really good. So if you don't do a good job for me, I'm not paying you. Good. Liquidity. How often can I get my money back or can I put more in? Once a month. So that's a difficult one from a business perspective because we want to invest in businesses for 5-year investment time horizons. But we might have investors that want their capital back for whatever reason. They might have taxes to pay, they want to buy a new home. So that's a tricky one because what we could do is we could lock up our investors and say, look, we take your money and we're taking it for 5 years. Now that's a hard sell for a lot of investors. A lot of investors are like, that won't work for us. Now there are investors that do, but there's not many of them. So from a business perspective, that's a hard one to do. From a portfolio perspective, that's ideal. We would only want investors that would give us their money for 5 years. But if I want to grow a business, we have to be a little bit more flexible. So we do monthly liquidity. So how do we manage that? Well, we manage that by the fact that the management team are the second biggest investor in the fund. So we provide an element of stability. And the other one is that not everyone can invest in my fund. We have one-on-one meetings with everybody. We have multiple one-on-one meetings. It's invitation only. So what I'm really trying to find out for our investors is how much of their net worth are they entrusting to me? In general, I don't want them to have in my, whatever I work it out to be, I don't want it to be more than 5% of their net worth. A minimum investment in our fund is $5 million US. So, on that basis, these guys have got to be worth 100 million plus. And there's a few reasons for that. One will mean that as long as we're less than 5% of their net worth, they're going to care less about the interim fluctuations in the fund. We want them to be really focused on that 5-year investment time horizon. Equally well, if we have a big drawdown because there's a global financial crisis next year, and their investment goes down by half, I want them to call me up and be like, I love you, I love the investment process, I'm going to give you another 5. I want them to average down. I don't want to be the first port of call where we're down 50%, they go, I want my money back. So there's two sides to that. So one is know how much of their net worth they're putting in our fund, know that they understand what value investing is, what we're trying to do. So to do that, we show full visibility of our portfolio to them. So we're happy to talk to all of our investors about our current holdings, we talk to them about our past investment mistakes, full transparency. So that way, if we do have a significant drawdown, they're more likely to call me up and be like, you know what, I'd love to give you another 5 million. Because although the portfolio is down, touch wood, it hasn't done this yet, it's down 50%. We know that you only own exceptional businesses and now they're all on sale. We want to buy more. Who doesn't want to buy more of a great business if it's on sale? So those are sort of the two sides to it, the portfolio management side on the one side and then running the business on the other. And as you can just see from those few examples, they don't always intertwine, but you have to do what's in the best interest of both at all times.
I can ask a bit personal about Loh-Gronager partners in general, about what the AUM is, if you can talk about it, and what in general the average return was in the last 3 or 4 years.
So technically speaking, I can't talk about either of those things. I can say that we're just under $50 million after 3 years in business. We started with $8 million, which was just from me and the management team. And it took us 10 months to get our first investor. And he put $10 million into our fund. So it shows you there can be quite a big lag between starting a business and actually having AUM come in. We don't leverage, we don't use options, we don't use derivatives. Our portfolio is 30 businesses, 15 are in developed markets, 15 are in emerging markets. Our median market cap is about $8 billion US. We own companies all the way from Thailand to Uruguay, Turkey, Kazakhstan. We own businesses in countries where most people have never been, companies that most people have not heard of. And that's where we add value, coming back to the question before, which is, when a high net worth individual or a family office comes to me, they've usually found us because our performance has been strong. They've usually been introduced by somebody else that's heard of us. And they've usually heard of us and they're interested because our portfolio looks so different from what other people own. We don't have any of the Mag 7. So they immediately look at me and they go, wow, half your portfolios in countries I've never even visited before. All these, even in the developed market side, there's businesses there that they've never heard of. And that's how we add value to their portfolios. Because if we're only 5% of their net worth, the other 95% is probably in other things. They might have a family business, they might own properties, they probably have money in other funds. And we want to make sure our fund is totally different from all of theirs. And at the same time, a one-stop shop where they can put their net worth, like I have. All of my net worth is in my fund. And on that basis, I'm happy because I feel like I've got enough diversification geographically across the whole world. Sectorally, we don't have more than 25% of the fund in any one sector. Business model-wise, we've got a diversity of business models. So that way we get the benefits of diversification while still having a concentrated portfolio. Because that's where all the alpha comes from. Ultimately, you need 100 bagger in your portfolio. And the maths of that is quite interesting. So if you've got 10 stocks and you put 10% into each of those 10 stocks, 9 of them go to zero. One of them is 100 bagger over 10 years. Your whole portfolio will annualize at 17.5% every year. So you can have 9 stocks go to zero. One goes up 100 times. More than makes up for all the mistakes. That's the power of a concentrated portfolio. That's why we only invest in exceptional businesses. Businesses that could be 100x. Thank you.
I love the point you made before, talking about learning from the successes of successful people and kind of analyzing them. Now, there's one thing I personally love doing even more, and that is to learn from the failures of successful people. Now, actually, you seem to do pretty well, right? But what was one of the failures in your life that you took most from, where you say that really changed the way I think and that still influences the way I act and behave to this day?
Absolutely. So I would be a really strong advocate. I'd say you learn way more from your mistakes and failures, especially of others, than you learn from your successes. Success takes care of itself. Failures are what we really need to be concentrated on. And I think that one of the best ways to learn is from the mistakes of others, because then you don't have to experience them yourselves. It's a much more comfortable thing to read a book about someone losing $1 billion than to lose it yourself. And there are obviously lessons to be learned from that. So when I talk about evolving our investment process evolves from investing mistakes that we make or those that I see other people have made. I actually go through quite a few of them in my book. But I give you 2 answers to the question. So one is, I talked earlier about patents, and I said that I found a company in the US that was applying for a lot of patents. And they were all in a particular sector, and that was the sector that this company was expanding out into. And from my research, I realized they were just developing an incredible niche in a new product that was going to come out, and that's why we bought shares in that business. But I have a counter example to that of a stock that we lost money on in China. And one of the reasons why we bought that stock was patents. So this was a company called Angel Align. It's the largest dental liner business outside of Invisalign. So Invisalign, I'm sure most of you know, so they're those retainers you put in your mouth, and they're clear and transparent, and they sort of adjust your teeth over time, and you can use them for like teeth whitening. So Invisalign is the main competitor to Angel Align, and Invisalign cannot compete in China because the Chinese authorities don't allow them to operate there. Angel Align essentially has, therefore, basically a monopoly on that market. And they're expanding out of China because they have a lot of technological advances over there where they can manufacture cheaper. So one of their main methods of producing dental aligners was actually 3D printing. So it was interesting. So we invested in Angel Align in 2022. In 2023, I went and visited China after about a year of us holding it. And the quarter-on-quarter changes I was expecting were not coming through in the financial statements. If you listen to the management quarterly calls and the annual call, they kept saying there are no competitors to us. You know, we've got the patented technology for 3D printing. No one else can do this. So that was interesting. So on my scuttlebutt trip to China, looking at luxury goods companies and shopping malls as well, I went and visited Angel Align. I met their management team, and then I just went and saw if I could meet some competitors in the local area of Shenzhen. And it was interesting, because, or it was eye-opening, I should say, because they had told me there basically are no competitors. And I almost had too many to meet. And I couldn't understand how that could be the case. And what it turned out was actually, the issue wasn't the fact that Angel Align, they did have the patent on this technology. The problem was it wasn't enforceable. The Chinese authorities had basically decided that it was a public good for everyone to have nice teeth. Therefore, everybody should be allowed to 3D print dental aligners. So their business model was fundamentally flawed. They couldn't enforce the patent. So that's an example of an error that we made, where we've now changed our investment process. So patents are really important, but there's a second level thinking to that, which is, are they enforceable in the market within which they operate? Important. And then I'll give you a personal example of something I learned from. So when I was 11 years old, and I was at the time living in Australia, my father was an entrepreneur, started and founded a few different businesses when we were growing up. So there were periods of time where we seemed to have a lot, and there were periods of time where we had less. And this was one of those periods. So I went to quite an expensive selective school in Australia, in Sydney, where we lived, called Sydney Grammar. And I was dressed in my school uniform, ready to go to school. And my mum said, just have a seat, I've just got something to tell you. So I sat down, and I still remember the colour of the walls in that room. And she said, you're not going to school today. And I was, why? She goes, can't afford to pay your school fees. So actually your dad and I are going to go into school today and find out if there's any way to keep you at the school. And I felt like my entire world had disappeared. Because you can imagine being in school, you've got your friendship group, you've got your friends, you've got the sports clubs, all that sort of stuff. And in that 1 second, my entire world disappeared. I've basically been told, you're not going to have any of that anymore. And that moment was a defining moment for me, because in that moment, if I look back, that's when I decided that I wanted to be financially independent. So the story ended nicely, whereby my parents did go to the school. They said that my academic record was relatively good, so they actually gave me a scholarship to the school, so I could continue going. But that, if I was to point at any period in my early life, that was the moment when I decided that I was going to be financially independent, where I did not want to depend on the generosity or kindness of any stranger ever again, whether that be my parents or whether that be the school headmaster. And that's where my passion and drive comes from. And I think if you look at quite a lot of entrepreneurs, it usually comes from a place of fear. That's usually the first thing. It comes from a fear of like not having anything again, or being at the mercy of sort of the kindness of strangers and not wanting to be back there. And one of the reasons why I'm comfortable with risk, you could argue, I've got my entire net worth in this fund, 30 businesses. What happens if half of them go to zero? I'm totally comfortable with that, because I've done the research, so I know that that won't happen, A. But even if it did, I'm happy to start again from zero, because I've done it before. But I don't want to go back there. So that's one of the reasons why we look for businesses. I said we could screen for different methods. I said anti-fragility, businesses with no debt. There's a reason why I don't want businesses with debt. I've seen it in my personal life. I've seen people go bankrupt. And they go bankrupt because they borrowed more than they can afford to pay back. So I don't want to invest in businesses, necessarily, that have loads of debt. Because what happens if they can't afford to pay it back? And I'm sure all of you have got different experiences in life, positive and negative. And thinking about those, or people that you've met, or people that have spoken here, or family members, no one's life goes up in a straight line. Even people you read about in books, Warren Buffett, Jeff Bezos, all of these guys have ups and downs. And learning from their successes is important. But I'd argue, to your point there, learning from their failures is far more important. Thank you. Sure.
Yeah, my question is, as a relatively smaller fund, the universe of ideas that's available to you versus like the larger funds, like let's say billions of dollars, right, are larger. So when you try to invest in, do you like deliberately look for like micro caps or like small caps?
So it's a good question. If you want to make really good, like really strong returns with arguably quite a lot of risk, people would say microcap investing is probably the place to go. The issue is there's only a finite amount of capital that you can deploy in microcaps, right? Because if the business has a market cap of like 10, 20, $30 million, it might have a free float of like $10 million, which means that even if you buy, there's probably only a couple of tens of thousands of dollars worth of shares traded per day. So on that basis, you can't deploy, a $50 million fund, a $100 million fund. It's possible, it's hard, and you need to deploy it over a lot of businesses. The other question is, you could earn good returns from doing that, but you're always going to end up being capital constrained. So if you're really good at microcap investing, you're going to end up very quickly with a serious problem, which is you have too much money. And too much money might be $10 million in what you're trying to invest in, just from a liquidity perspective. And this comes back to a little bit to your question earlier, which is like business model versus investment model. So from a business perspective, for a hedge fund to be successful, you need to make good returns, but you need to be doing that on a significant amount of AUM. So it makes no sense, in my opinion, to run a business that invests in microcap companies, because it's a really difficult business model. You can't really scale it with the AUM. So I said that our median market cap of our 30 businesses is $8 billion. So that means that we own pretty big sized businesses. And one of the reasons for that is the fact that our track record, when we meet investors, so we talk to US university endowments, for example, their minimum investment size might be $250 million. And their first question to me is, Ardal, if I give you $250 million tomorrow, does your portfolio change at all? And if the answer to that question is yes, it probably means they'll never invest in you. Because if you've got to change your portfolio holdings because new AUM's coming in, that basically invalidates all your previous track record. Because it meant that you might have made really good returns investing in small caps, but if I give you $250 million, you all of a sudden need to be investing in mid caps. Well, your track record was in small caps. Is that can you extrapolate that to mid caps? I don't know. I'd rather sit there and watch you do it. And then if you have a good return there, then I'll invest. So from a business model perspective, we need to make sure that the businesses we invest in are large enough so that when we are a multi-billion-dollar fund, I don't have to change the portfolio holdings. Really important from a business perspective. Really, really important. So arguably we could make better returns if we just focused on, say, sub-100 million market cap businesses. Potentially possible, even with our strategy, but it would not be a scalable business. So I'm willing to accept investing in slightly larger businesses where potentially the returns might be marginally less, but where the business is scalable. Otherwise, I should just manage my own capital and not manage a fund.
So when you say the most important thing when you're operating a fund is to maximize the percentage of the return rather than like the total return.
So we'll never take capital if we thought that it was going to reduce the returns of the overall fund. So for example, if we can't find any good investment ideas, I'm certainly not going to take any money from anybody. We're only taking capital because we think that the businesses in our fund already are still really, really good value. So we want to put more capital into them. So the returns are the most important aspect. But fundamentally, if you're going to try and build a business, if you make 20% returns on $10 million, so you make $2 million a year for your investors, and you take 20% of that, so you take $400,000 as a profit per year. But you're investing in microcaps, so you can never manage more than $10 million. So you make 20%, you get $400,000 for yourself, you give $1.6 million back to your investors every year, because you're like, thanks so much for the capital, but I can't deploy it. It's not a scalable business. Whereas with my business, if you give me $1 billion tomorrow, I can manage that. If you give me another $1 billion the following year, it doesn't change our portfolio. Our portfolio up to $6.5 billion of AUM, we wouldn't have to change it from a liquidity perspective at all. That's a really scalable business. And managing our portfolio at $6.5 billion versus just under 50 today, I think would actually be advantageous for our returns. Because one of the things we didn't touch on here is we engage with all of our portfolio businesses. So we go there, we meet the management teams, we give them what we think are good ideas. We try to give them advice where we think they could improve on certain things, especially on environmental, social, and governance goals, which we think are quite transferable between different sectors and industries. So we look to add value to them. But why would they listen to us if we only own $2 million of the stock and they're a multi-billion-dollar business? So therefore, being a $6 billion fund, we might actually be able to implement real change in some of those businesses, and that might actually increase our performance over time. So that's an example where some people say increased AUM leads to performance drag. I think depending on the strategy, increased AUM can actually lead to increased outcomes up to a certain point. And if you want a really good example of that is TCI, the Children's Investment Fund run by Sir Chris Hunt. Managed $70 billion at last count, I think in January. A portfolio, it's not the same portfolio as ours, but similar strategy. You know, it's a scalable business. And if anyone wants to see how much Chris Home made this year, it's a ridiculous amount of money. I think his fund was up 20% halfway through the year, and that's like $2 billion to him. Most of which he gives to charity, which is fantastic. But that's a scalable business. Thank you. Sure.
What do you look for in like management besides shareholder alignment, high insider ownerships? Like, what are some of the things that you like specifically look for when you meet them?
So I would say that meeting management teams in a way can be a privilege, and on the other side of the coin it can be a handicap. So I wouldn't discourage anyone just because you can't meet the management team of the business not to invest in it. You can kind of get access to them through the quarterly calls and the AGMs and the annual calls and the like. The one thing I've always tried not to do is to really meet the CEO. Or if you're going to meet the CEO, you want to meet them last. CEOs are generally the best salespeople for their business. Most businesses, especially if you guys do internships, you'll realize that every business is quite political. No matter what team you work in, there's a hierarchy within the business. So the CEO of the business is usually the strongest political animal. He's managed to rise all the way to the top. We've already said he's probably only going to be in a job for 4 years anyway. So he's really trying to make sure that he gets paid for all that hard work that he's done. And he's usually the best salesperson for the business. So I normally find you get the least, not the least honest is probably the wrong way to phrase it, but you get the least straightforward answers to difficult questions. Sometimes you get the best answers to questions from people that you meet walking through the factory floor. You get to have a site visit, or someone more junior in the hierarchy. Investor relations in general give you the same answers to every question they give to everybody. There's no insider information. The CEO is never going to tell you something that is not public knowledge. But you might just be looking for mannerisms. You know, you go to the company, you look at the car park, and it's like there's 6 Ferraris, and they're all reserved parking spaces. And you might look at that and you're like, how does that marry up with the fact that this is a sustainable recycling business? You know, how does that work? And then you can also have small talk. You know, you ask the CEO, going on holiday, and they'll be like, yeah, I'm going to the Maldives. And you're like, oh, that's interesting. How are you going there? And he's like, corporate jet. Might be a bit of a red flag that he's using a corporate jet for personal reasons. It's probably an unlikely scenario, but those are the sort of scuttlebutt things that you can pick up when you meet people. Does he seem to be an honest person? Judging people's character is usually quite hard. But Buffett gives the famous example where he goes at a cocktail party of 100 people. He goes, if I shake the hands of all 100 people, he's like, I can pretty much guarantee you that I can pick the 2 best people in the room, the people that I would want to spend time with. The other 98, no opinion, no idea. But he goes, I'll just hang around with those 2. And I think that's kind of what you're doing when you're trying to meet management teams. You're trying to find people that are exceptional. And I'm pretty sure if you met Elon Musk even 20 years ago, he would have jumped off the page at you as someone that was just totally different from anybody else. Thank you for the questions. And if that's all from everybody, thank you so much for your time this evening.